All right, let's jump right in. We all know that financial markets are, well, incredibly complex, and for decades we've been trying to predict which way they're going to go. But the traditional forecasting methods, they often feel like they're just one step behind, especially when a big crisis hits. I mean, think about the 2008 financial meltdown. It really showed us that the old tools just weren't cutting it anymore. So let's dive into what comes next.
And that really brings us to the core question, doesn't it? In a world that's packed with uncertainty, ambiguity, and just sudden out-of-nowhere shifts, is it even possible to get a better handle on what's around the corner? I think everyone wants to know how to navigate that kind of financial uncertainty. Today, we're going to look at a new set of tools that promise to go way beyond the old crystal ball.
You see, the problem with a lot of the old models is that they basically assume the world works in a neat, straight line. But we've all lived through it, and we know reality is just way messier than that. Financial data has all this stuff: nonlinearity, structural breaks, volatility clustering, and what that really means is that markets don't move in straight lines. The rules of the game can suddenly change, and you get these quiet periods followed by absolute chaos. Simple models just can't keep up with that kind of messy reality. So, our first stop is a really powerful idea. What if we stop thinking of the market as one single thing, and instead think of it as having different kinds of weather, or what the experts call regimes? So, what exactly is a market regime? Well, just think of it as a particular state the market is in. For a while, things might be pretty calm, just steady growth. But then it can suddenly switch into a state of super high volatility and total uncertainty. Just being able to recognize when that shift happens is the first crucial step toward making better forecasts. And here's the key difference. The old models, they kind of treated the market like a set of dominoes, right? Assuming that one event would just predictably lead to the next based on a fixed set of rules. But the newer thinking sees the market as something more like a river. It recognizes that the market's memory isn't always the same. Sometimes, when the water's calm, only what just happened really matters. But other times, during a flood, stuff that happened way in the past can still be driving the current. The system itself actually changes. Now, this is where it gets really cool. How can we spot these big regime changes without having to rely on a specific pre-built model? Well, take a look at this chart. It uses a concept from something called information theory, specifically normalized mutual information, or NMI. Basically, it measures how much the past is connected to the future. Now look at that bottom panel. In normal times, it's hovering near zero, which suggests an efficient market. But then, look at those huge spikes right during the 2008 crisis and the COVID-19 shock. That is a clear, data-driven signal that the entire structure of the market has fundamentally changed. Okay, so seeing that the weather has changed is one thing, but what do you do about it? How do you make decisions when you're facing that kind of deep uncertainty? Well, this brings us to our next set of tools, which are all about how we quantify the unknown. And this is where something called Bayesian inference comes in. It's actually a really intuitive way to think about uncertainty. You just start with an initial idea, a prior belief, your best guess about the market. Then, as new information rolls in, you systematically update that belief. It's basically a formal, structured way of yearning and adapting as the world throws new stuff at you. And this quote just nails it. The point isn't to throw out your intuition. It's about making it better, about refining it. It takes our educated guesses and turns them into something much more rigorous, an evidence-based probability. When the market gets really turbulent, we also need better ways to measure risk. You've probably heard of value at risk, or VAR. It tells you the most you're likely to lose, but what about the really, really bad days that go beyond that point? That's where conditional value at risk, or CVAR, comes in. It asks a much scarier but more useful question. If things get truly awful, what's our average expected loss going to be? I absolutely love this analogy because it makes the difference crystal clear. VAR is like knowing the height of the fence you're trying not to fall over. It's just a single number. But CVR gives you that crucial information about what's on the other side. It tells you, on average, how painful the drop is going to be if you do go over that fence. And for managing risk, that is a much, much more useful piece of information. Okay, now for a concept that really shows just how complex the market is. It's this idea that the market isn't just some passive thing we're all watching. The very act of us participating in it actually changes it. This concept is called reflexivity. And it's all about a two-way feedback loop. Think about it. When investors get optimistic, they start doing things like lending money more freely that can actually make the economy better, for a while at least. And then that positive outcome reinforces their original optimistic belief, which creates this self-feeding cycle. The investor George Soros is really the person most famous for hammering this idea home. He basically argued that our view of the world is never perfect. It's always a bit flawed. But those flawed beliefs don't just sit there. They actually feed back and help shape the very reality we're trying to understand.
And you can see this play out perfectly in something like the credit cycle. It kicks off with a wave of optimism. That makes investors willing to lend on easier terms, so credit gets cheap. Because it's so easy to refinance, fewer companies default. And when investors see those low default rates, what do? They get even more optimistic. And the whole cycle just keeps feeding on itself. Until, of course, it doesn't. That feedback loop is exactly what drives those massive booms and busts.
So how on earth can you possibly model a system that influences itself? Your standard models, the ones that just try to predict a single outcome, they just completely fall apart. And that's where these cutting-edge tools like multivariate diffusion models come into play. Instead of trying to pinpoint one single path for the future, these models map out an entire universe of possible futures. They are built from the ground up to handle these complex, shifting relationships between different assets, which makes them perfect for a reflexive world.
So, let's put all these pieces together. We've talked about market regimes, we've looked at Bayesian thinking, better ways to measure risk, and this idea of reflexivity. This isn't just a random collection of interesting theories. This is a whole new toolkit for trying to navigate uncertainty. This slide really ties it all together nicely. To deal with the fact that markets are always shifting, we can use things like regime switching models and information theory. To handle that fundamental uncertainty, we turn to Bayesian inference. For measuring that scary extreme risk, we've got conditional value at risk. And to model the market's crazy feedback loops, we have ideas like reflexivity and tools like multivariate diffusion models. What you're looking at is a specialized toolkit, where each tool is designed to fix a specific problem with the old one-size-fits-all approach. At the end of the day, the big takeaway here is a huge shift in how we think about this stuff. The goal isn't to find some magic formula that can perfectly predict the future, because let's be honest, one doesn't exist. Instead, the real focus is on building portfolios and risk systems that are tough, that are adaptive, and that can handle a whole range of possible futures by just embracing probability and complexity. So no, these advanced frameworks are not going to give us a crystal ball. They won't give us certainty. But by helping us get a better grip on market regimes, to quantify uncertainty, to measure that tail risk, and to account for these crazy feedback loops, they really do offer a path toward building a more financially resilient world. But it requires a whole new way of thinking. And that leaves us with one final question. Are we ready to move beyond the illusion of simple predictions and truly embrace the market's complexity?